is recommended and or purchased by advisor or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Seems like this last week was a long one. Not sure why that is. But, yeah, at least we're here now. Hope everybody has a good weekend, good Saturday. Just looking through all the stories that have been popping up over the past few weeks. And it's interesting. You know, I still, after all these years, you look at how things are going, and you realize a couple things. And I read about this, I don't know, it's probably a year or two into this industry. That's a long time ago. And this guy was saying, you know, history repeats itself. The names and faces change. And, there's a lot of similarities in what we're going through now and a lot of other time periods in the United States. And so you go back and you look at those things. Where are they similar? Where are they different? What kinds of things would that actually benefit? You know, what kind of industries? And there are a ton. And I'm really kind of tired. You know, bad news sells. If it bleeds, it leads. It's an old line. Actually, it's older than I am, believe it or not. But so the media, news media, is not there to help you. They're there to get your attention. And that's how they sell ads. And I know I've talked about this a million times. You're probably tired of hearing about it, but it's still going on. So as long as they're going to keep doing it, I'll just keep pointing it out. But and why? Well, because when you get upset, you tend to make mistakes. It's a lot harder to make a good decision when you're feeling stress than it is when you are comfortable. And there are always a lot of things to feel stressful about. I mean, there are always things to feel stressful about. This time, when they go, I'll say this time it's different. Well, you know what? It's actually different every time. Could be worse, could be better. I can tell you that emotions are higher than they would be under most conditions, or under many conditions anyway. And that makes it difficult to make good decisions. And as you start approaching retirement and you make one or two bad decisions, that can have a fairly large impact on the rest of your lifestyle. And the right thing to do is the same thing you would do in good times, actually. It's just going to be different percentages. And quite frankly, if you line up your portfolio so that the funds that you're using are adjusting themselves, that's one of the really nice things about today's markets. You read the description of what the fund is actually doing. You need to do that, okay? Or at least have somebody tell you on the inside what they're doing. And I always like to go back and reread the description of the fund's objectives, so that when times are hard, markets are going all over the place. By the way, I don't have a whole lot of time to read because my phone is lighting up when that kind of stuff happens. Not so much anymore. It's interesting. I think I've thanks to WHK and all the time, effort, and energy over the years, got a really nice client base. I have very nice clients. I don't think I have a single client that I don't get along with, which is problematic, actually. because when I call them, they don't call me back. They're not worried, so which is a good thing. But you should call me back because I wouldn't be calling you unless I had to do something. And it's kind of a big deal. See, I'm glad I'm glad they feel safe, protected. But man, I got a job to do, and that job is not include calling you 3 or 4 times, just to get one call back. That's just not going to work. But so I think this is like the first time I've ever been that blunt about that. And I guess it's because I'm getting older. But realistically, you get an advisor and they're giving you a call them back. It's very infrequent that somebody is calling for no reason. And anyway, but I was looking at, and I'm sure, by the way, because of all the things that are going on now, that's one of the benefits, I guess, hidden benefits of Trump. He's got everybody paying attention, paying attention very closely. Unfortunately, there are some industries that are hurt by this. GDP growth, and it's always going to have bumps. There's always ups and downs. You look at it, they're just focusing on, the rhetoric that's current because he's a showman. I mean, above all else, that's what he likes, gather the attention. And that's fine. The main things are still working. You've got to understand there are over 300 million people in this country. Everybody's got to eat. Everybody's got to drive. Well, you have to drive cars in America. I can't imagine being without a car. I can in New York City, or, if you live downtown Los Angeles, something like that, you could get by without it. In fact, in New York City, you probably have to get by without it. But most of the place, there's still a tremendous amount of land. More than half the available land in this country is not settled. There's nobody living on it. So that's another thing America has is land. Go to Europe. See how much land they have in Europe. Take a flight over there, look down. And anytime I take a flight and I look down, I'm like, wow, look at all that farmland. Holy hell, nobody's living there. So we've got a long way to go. And don't believe the press. And you have to, when you're reading articles, whether they're in a newspaper or magazines, whether you're watching it on television, you have to understand that the channels, whatever they be, whether it's actually a news channel on cable or a paper as a source of a channel, not many people read them anymore. Magazines, all the media, they've got one goal, and it has a tendency, actually they have this one goal that has a tendency to outweigh, in order of importance, all the others. And that's get your attention. Because if they can't get your attention, then they can't sell ads. And unfortunately, that's just the way it is. So you need to look at everything that you're hearing. If you hear something, wherever you hear it, or if you read something, or if you see something on television, and it's upsetting, just get on the internet and do your Google search and just try to verify with. I try to get at least 4 or 5 sources to verify something when I see something that I think is disturbing. And it's very calming because, first of all, you're doing something. You're being occupied. Secondly, about 9 out of 10 of those times, probably actually more like 19 out of 20, there's nothing to worry about. And that 1 out of 20, you'll figure out, if you keep doing this for any length of time, that you're not the only one that realizes that. In fact, you're reading it online or watching the videos, and there are already big teams working on those issues and those problems to make them go away. And so you can feel you can feel a lot better about a lot of things. Yeah, and there's the last couple of years, the chaos is mind-boggling to how much we've had relative to what we've had under prior administrations, even this guy's prior administration. Wasn't anywhere near what this is. And I'm not sure what's going on there, but I'm pretty confident that we'll come out of it, and we'll actually be better for it. Every time there's turmoil, people spend money, companies spend money, governments spend money to be able to solve those problems, hopefully in a peaceful way. That money goes right into the economy. When they are spending this, it's not in a vacuum. It's not like you're putting it in there, it's gone forever. They're buying all the equipment that they need, all the clothing, the hospital supplies, all the salaries, all this stuff is, it increases GDP. It's increasing it by, borrowing, which is at some point in time you'll have to deal with. That means in the future, it's not like everything's going to shut down. Everything's going to get more expensive. That's how that works. And it's probably not going to double in price overnight, but, you get a 4 or 5% inflation rate, 5 or 6%, and, you're doubling prices about every 20 years. Because it's not a straight line either. And normally you'll have a few years of above average inflation, then it goes flat and can even actually contract a little bit, which is good for, if the money supply is actually extended to cover the inflated economy. And then when the prices start to stabilize, incomes have gone up and savings begins to increase a little bit. And I know it never works in a pattern that you can recognize. And when they say it's different this time, I think they were looking at financial markets because it's always different. There aren't two situations that work out exactly the same way, and that's what makes it really difficult on analysts. Because they're trying their best, and some things you just cannot foresee. That's the way it goes. That's life in general. But you can it doesn't mean you shouldn't try. You'll get a lot farther by trying to estimate what you think your future costs are going to be, what you think the investments might be. And trying to match those up together. Can my income meet my needs in the future? That's a big one. And I really think they should start teaching that subject right around when the kids turn around 12. Because at 12 years old, especially today, you've got kids writing computer software. You've got them doing almost everything. And it's just mind-boggling how advanced these young ones are. Gives me a lot of confidence for the future, quite frankly. Got a lot of really smart people in this country. And for the most part, we're still all very free. Free to pursue, free to learn, free to start a business. And even though that's, it's not easy. But you still have the chance. And it's like that in a lot of countries. There's a lot more regulation in a lot of countries. Taxes are a lot higher in a lot of other countries. And I think we're all getting closer than most people think to doing a lot of things very, very similarly. But having healthcare, universal healthcare, I think it's a kind of a good idea. And I know you say that to people who are staunchly opposed to that. They're not going to agree, but I don't care what statement you make. You're going to find a whole bunch of people that disagree and a lot that agree, and some just don't really care. But it's just the way it goes. Anyway, I was looking at financial markets, and I'm like, wow, this is actually, they're not bad. The valuations, are they ahead of themselves? Well, yeah. And most of my career, market's gone from being a little overvalued to a little undervalued, and a little overvalued, a little undervalued. And occasionally it'll get very overvalued, and then when it comes down, it snaps back. Typically goes past the point where it comes to be very undervalued again, and those are really the time periods where you can make some really big money. But you have to recognize that, and to be able to recognize it, not that easy. I really like the actively managed accounts that I have access to, as I use a couple different vendors, but I like what these guys are doing. I've put up my very best model, my very best stock model against theirs, and they are so neck and neck. It's not even. It's hard to measure. One day one will be up a 100th% more than the other one, and then the other day it reverses. And over time, I can say that I feel blessed to have access to multiple models, and because they're your personality is going to have a lot to do with how well you do in financial markets, and that's a fact. Some people have they're not even they don't even like to study financial statements. They don't want to deal with investments, and but they have this strong inner strength that allows them not to panic when things aren't going the right way. And then you get other people who are really bright. And by the way, the ones that are incredibly bright, they have a tendency to overreact. Not all of them. Matter of fact, the home run hitters are the ones that keep their cool and are really bright. Those are people we call superstars. And as far as investors go, what would that be? What would that look like? Well, when the market's down a whole lot, there's not much change in your tone. You're not calling and trying to recheck everything, and that's hard to do. Anyway, I have to take a real quick commercial break. This is Bill Bullington. I'm right here on 1420. Number's 216-901-0945 if you want to call in, and I'll be back after these messages. This is Bill Bullington here every Saturday morning from 10 to noon. I keep forgetting that I added that extra hour on there. Anyway, if you'd like to call, the number is 216-901-0945. And you can reach me directly if you want to go to my website. It's bullingtoncapital.com. And my email address is bill@bullingtoncapital.com. So if you'd like to reach out, if you have any questions, please feel free. Part I like best about this business is getting to know new people and meeting up with older clients that I've had for a long time. And let's see, this is pretty interesting. It's amazing how high the quality of a lot of the data that you can get is these days. I have a subscription to a Bloomberg terminal, and if it's not in there, you can't find it. They really do a great job. But actually, one of my favorite financial magazines is Kiplinger, and so I really like that. And they've got a let's see, which issue was this? It's fairly recent. Oh, it's the May issue. Okay, and I really liked that one. They had they're ranking these companies by environmental stewards. Those are the people that are trying to do the right things, not just economically, but they try to hire from all types of races, and they're trying to keep their clean up after themselves. So they say. Okay, I'm not there. I'm not an officer. I'm not an inspector. So I know occasionally over the years, these guys have gotten caught. Not all these guys that I'm talking about right now, but companies have gotten caught by fudging things a little bit to try to save a little bit of money. Bad idea. That is just a really bad idea. And anyway, So they were ranking some of the companies, and I thought it was interesting to see some of the names that I recognize. First on their list was actually Costco. Costco's got a price to earnings ratio at the time of the publishing of this article. It was 49. That is not inexpensive. You're paying 49 times the amount of profits that they're generating to buy it at its current price. Now, it could be something, maybe they took some had big expenses, and it lowered that profit margin. Anything could have happened. Could have been a one-time thing, but that's where you need to go and look and find out into the past. Look at the past 10 or 15 years. Read the management's discussion over that time period. Now, by the way, those are the two first things you should do, and then you can add anything you want to there. And over time, you'll learn, and that's why we have portfolio managers. Because I really don't want to. I haven't wanted to do that for a few years now, but I found a service. It's actually through one of my providers that does that research, looks at the what's going on at the companies, looks at the valuations, and then portions it according to their methodology, which weights stocks based on their values. And I really like it. I mean, I'm very pleased. Now, it's not for everybody. In fact, there's nothing that you can say about investing that would be right for everyone on the planet, other than the fact that you should. Okay, you should invest in something. Something is better than nothing, and I don't really have to say. When I was younger, that was probably more prevalent because there were a lot of people that had access to 401k plans and they weren't using them. They just weren't using them. Hey, did you invest in your company's 401k plan? Nope. Why not? Oh, I just don't want to, or they had beef with somebody at the management of the company, or they didn't like the presentation, whatever. That's the first thing you should do. As you start to get older, when you're starting to get into your 50s, that's probably when you want to start to really take a look at how much risk you're taking. And you're going to try to evaluate that risk. You're going to try to start to dial back a little bit. Here's the good news about today. Interest rates are a lot higher than they were a few years ago. I never thought that interest rates would get as low as they did. But interest rates today are significantly higher. And are they going to go higher or lower? I don't know. If the economy continues to expand and expands quickly, then they're probably going to raise interest rates. And but if the economy starts to cool off, they're probably going to freeze them. It might even cut. And I know this is one of the reasons that the Federal Reserve is independent, and it should not be a political move. That's the way it was intended when they first set this system up. That's one of the reasons America's economy is so strong. You got the Federal Reserve is the banking system. The banking is like the blood flow of the economy, life flow. And you start trying to restrict it or doing things that, you making money too easy to gain, then you start having, high inflationary environments. Inflation goes up, and you got to raise interest rates, which beats it back down. But it doesn't move smoothly. Throughout all these movements, the movements have a tendency to be quick and sharp, and that scares people, especially if you're getting close to retirement age. And that's one of the reasons a few years ago, probably the first 20 years I did this show. Yep, it's been longer than that. But the first 20 years, I talked mostly about stocks. And most of my clients have a tremendous amount of money invested in stocks or stock funds. And that was because I was younger, because it depends on the client's age. A lot of them, it's always dependent on their age. And side note, I put this risk profiler in action. I didn't call it that at the time. I just was trying to evaluate somebody's risk tolerant, how much risk you could actually take. And I looked at all these questionnaires from all these providers out there, and like 4 or 5 pages. And by the end of that, you're exhausted. And I know that that was one of their ploys, so for lack of a better word, to increase their client base, is to give them all these questions that a lot of people, quite frankly, they didn't know how to answer it. And so by the time they got done, the frustration level and the amount of time that they had spent was so high. They'd spent a lot of time, got a lot of frustration. And that was part of the tactic, the sales tactic. They're never going to want to go through that again. So they're probably not going to be moving unless you just do something really, really drastically wrong. And they weren't wrong. I mean, that's how the human psychology works in a lot of cases. And I always thought, man, what a waste of time. And you get through that whole thing, and you still don't understand anything that they're saying in a lot of cases. Now, by the way, there are some really good advisors that sit down and explain that and take their time so that you do understand. And they're in the top 5%. 19 out of 20 don't want to take that kind of time, especially these young ones, man. And I don't know. It's a little impatient, but that's okay. I guess it comes with their age. I can just tell you that was another reason that I kept working on my questionnaire. There's got to be a better way, and there is. So here's what you do. So I'm going to tell you this over the phone, and I'm giving away these secrets. I'll probably be banned from the radio. I'm just kidding. But what you do, the simplest way to do this is write down the amount of money that you have in your investment accounts. What are investment accounts? Well, investment accounts are money that you're saving to be able to try to replace your income when you retire. That would be, so you can say, well, that's a retirement account. Yes, but you're investing in that money, correct? Well, yeah. Well, then it's an investment account. And it just happens to be tax deferred. And that does make a little bit of difference. Actually, a lot of difference going down the road. That's something you can address, but that's beyond the scope of today's conversation. Don't get old, people. But anyway, so here's what you do. You write down all the value of the accounts that you're going to be investing. And by investing, I mean you're going to be buying stocks, bonds, cash, whatever your risk profile comes back as. That's another area where I have it, where it's a struggle. It's hard to evaluate what kind of risk taker you are. And this is what, and I'm about to tell you what the most important questions are. So if you're listening to this, pay attention. If you're not already a client, and really pay attention. Okay. But write down the amount of money that you have to invest, and then start subtracting percentages from it. Okay. So keep my math easy. Let's just say I got 100,000. Okay. I'm using that because it's simple. Okay, so I have 100,000. If I saw that drop down by 10%, that's $10,000. It's 90,000. Write the 100,000 at the top of the paper and write down minus 10% equals 90,000. Okay. Are you ready to panic? Are you panicking? Most people probably not. I'm not. And I encourage you that if you are, try to work on yourself to increase your risk tolerance a little bit, because it's going to be very difficult to make a decent amount of money over a long time period. In other words, you're going to miss out on some big gains from the stock market if you're not willing to take more than 10%. Because here's how you figure out how much money you're going to put into stocks using that little formula. Okay. So if 10% is my risk tolerance, I mean, I don't want to be down more than 10%, then you can't put more than 20% of your money into stocks or stock funds. And I'm assuming that 10% is going to be in a diversified stock portfolio, not a stock. Okay. After all these years, I've learned you have to be incredibly descriptive of everything that you are talking about, because somebody out there is going to reinterpret your little speech to fit their own mind of how they think things should work. And it's not going to be how it actually works. Okay, so anyway, if you've got a 10% decline tolerance, don't put more than 20% of your money in stock. Put the other 90% in something safe, treasuries, CDs, get some bond funds, the short-term maturities on the average maturity on the bond fund. It shouldn't be more than 2 to 3 years. You won't make a whole lot of money on that, but you're not going to lose much when the market goes down either. And will you lose anything? Not if you don't sell. The share price on it's going to fluctuate. Those don't fluctuate like stock funds do. They're a lot less. And if you're reinvesting the dividends, you're buying more shares. That share price drops. The percentage that you're getting actually goes up. Let's say a $10 stock goes to $9. Well, that's a 10% decrease. That means the income that you got, let's say you're getting 10%. I know that doesn't exist right now, but if you were, to keep the math simple, you'd be getting let's say it's a $10 stock. So you're getting $1 a year. Well, it goes down to $9. Well, they're not cutting the dividend because the share price dropped. So you're buying more shares now, and they're on a discount. And by the way, that dollar is a higher percentage of 9 than it is of 10. So you're buying more shares at lower prices with a higher yield. Woohoo! I just solved a big problem for an awful lot of people. And if you didn't get that, again, I hope you're not writing this down, because you should be in your car driving. So just call us. That's why I'm available most of the time. BullingtonCapital.com. You can go there, and all my contact information is there. Whether you want to use email, phone, you name it, we'll try to get back to you. So anyway, I just lost my whole train of thought there, but that's okay. I'm going on to the next story. So I like to read. There are a lot of publications, actually some really good publications. I have a Bloomberg terminal, a Bloomberg subscription. If it's about a publicly traded company, it's in there. It's like that old commercial, it's in there. I forgot what that commercial was even about. Yeah. That's how old I am. But that commercial's got to be more than, it's probably almost as old as I am. I was a kid when they started playing that. That's pretty funny. Anyway, there's a pretty nice article, and the headline, or the headline of the article is what caught my attention. And it says, "I have seen this all before." And it's an interview, and it's on income investing. And income is trickier than stocks are, by the way, because there are so many categories of income. What do you mean, Bill? Well, you have preferred stocks. That's a stock that pays a big dividend. It doesn't go up or down whether the company had a good year or a bad year. It could be a convertible stock where it pays a dividend, but you could convert that stock into the common shares if you wanted to. So if the stock goes way up in value, you make a little bit more money. You normally don't make as much on the income portion. They won't guarantee as much because they're giving you the option to participate in the appreciation of the underlying stock. Not very popular anymore, but actually none of this stuff is. I can't tell you how many people don't buy stocks. And a lot of the ones that are buying stocks that have called in from this radio station shouldn't be buying stocks. they're not doing their homework. They're not, yeah, I'm asking, well, what are their pre-tax profit margins? Yeah, so you shouldn't be. That's like getting in your car and trying to get to some place that you've never been to before without a map or without your cell phone. Will you get there? Well, if you do, it's not going to be skill. And you're going to have a tremendous amount of luck. Okay. So I only got about 20 seconds here before I got to take a real quick commercial break. So I'm just going to tell you, my name is Bill Bullington. I'm here every Saturday morning. Like it or not, you can look me up at bullingtoncapital.com, and we're about to take a real quick commercial break, so I'll be back in a couple minutes.
Do you remember?
Hey, this is Bill Bullington. I'm here every Saturday morning from 10 to noon. You can go to my website, bullingtoncapital.com, if you'd like any more information on anything you hear me talk about here. I run a small investment advisory firm right here in Northeast Ohio. And, man, I can't believe how long I've been doing this. It is mind-boggling. Anyway, I like to try to help people get to a place where they feel comfortable, where they can feel confident. And, I know most of this show has is focusing a lot on really negative news. And here's the idea behind that. Okay. You have to deal with reality. Okay. And I don't see a lot of the negativities as being negative. I think it's reality. Okay. This is what you have to prepare for. And it's not that bad. I'm telling you, I've been doing this for 30 years. The thing that's bad is if somebody doesn't expose the risks, all of the risks. Once you find out about them, it's typically because that bad thing happened that they were hoping wasn't going to happen. If you live long enough and you're investing, you're going to see that stuff, and it's called volatility. You look at your account and it's way up, new all-time highs, and then a month later, holy cow, I'm down 10% in a day. I've lived through that many, many times. Yeah, that's what happens. You can't really avoid it, but the things that you're doing when the market's not going down are the same things that you should be doing when it is. And in most cases, I like to hire out the people that I know are going to do the things that I used to do manually. We used to do in our office. I found the not investment advisors, they're institutional portfolio managers, by the way. Why do I use them? Because they're doing those hard things. They've taken that. I've outsourced that. I've got there are actually several thousand different options there. That is really hard to go back and read all those to find out what they're doing is not an easy task. And but if you're going to call yourself a financial advisor, you'd better get on it. And most do. Yeah, the vast majority of them do. And one of the differences between what an investment advisor might do and what an individual investor is, the individual investors just look at the track record and that's it. That's it. That's the extent of their research. I'm like, yeah. Let me ask you a question. Did you get in your car and drive to work yesterday by looking in your rearview mirror at where you had been? It is exactly what you're doing when you invest that way. Well, it's been the best one in the best. Okay. That's a starting point. That's not the end point. The next step is, okay, we're going to look at top performers. Now we're going to ask, okay, what kind of tactics are they using? How are they selecting those stocks? Are they done by size, by profitability? Those are really important, by the way. Are they just size and size alone? And so, yeah, well, most of them are, by the way, most indexes are heavily influenced by just the public's reaction to what that stock has been doing over the past 6 months. And think about that. That's exactly like getting in your car and driving in the rearview mirror. Now, you could do that. I would not recommend it. And I definitely wouldn't recommend it when you're looking at trying to put together a financial plan for your future. Not good. I wish it were that easy, and what's really rough is when somebody does that and they get lucky, which has happened to me multiple times earlier in my career. I got lucky, confused luck with skill, and I stayed there until, what goes around comes around. and I got whooped, and it's mostly my accounts. And I watched a lot of clients, back in those days, a lot of clients would hire an advisor and them wouldn't listen to them at all. They would, I was thinking, why did you get an advisor? And they really were looking for verification that whatever they were doing was the right thing to do. And sometimes it would be. And I still have clients, I wonder to this day, why do you have an advisor? I mean, they are really good investors. And some of them, I've gotten some of my better ideas from. Okay. So I find that to be hilarious, but because, they don't really need me. They don't. These guys could go into my field tomorrow and would be very competent. So anyway. Setting all that aside, let's concentrate on what you need to do. So if you want to replace a big chunk of your income in retirement, let's say you could get by on, I don't know, a good number typically through the industry is somewhere between 70 and 80%. 70 and 80% of your pre-retirement income. That is a monster to tackle, incidentally. And this is one of the reasons I went to my kids' schools when they were little. And I was giving these presentations to these fifth graders. And because by that time they had learned, compound interest calculations, and at least the ones in my kids' schools did. And they may have been ahead. I don't know. It's been too long since I've actually done them. Anyway, they tended to get it really fast. I mean, super fast. These kids are like 11, 12 years old. And today, 11, 12-year-olds have their own YouTube pages. Their parent had to open for them. But it is mind-boggling how smart some of these kids are. Anyway, it's going to take more than intelligence. And I think that's a part that you really don't hear a lot about when you're reading. I read a ton of financial stuff. And almost nobody almost nobody talks about the emotional intelligence that you got to have. And that's more important, I'm telling you. It would be great if everybody had the, it's one of the things that makes Warren Buffett stand out. That dude didn't start buying bonds, and, I think it was just within a decade ago. Okay, he's in his 90s. He bought all stocks and just weathered, the ups and downs. He had complete confidence, and I get it. And I have complete confidence. And sometimes that alarms people who are not as confident. And so I set up a set of rules, just observation, watching what was happening, and what people were doing, and a lot of people hire an advisor and then don't take their advice. They hire an advisor, like hiring the advisor is going to make the idea that they have that probably isn't going to work. Somehow it's going to work because they have an advisor. And, I can't tell you how many people have gotten up and walked out of my office because I said, that's not going to work. I'm sorry. But you don't know enough. At some point in time, it's going to come back and hit you. And I hope it hits you sooner rather than later when you're younger and you have time to recover. That's, that would be the best, because I've seen enough people where they got to that retirement age, they're getting ready to retire. They didn't bother de-risking their portfolio, and then they had a big correction and ended up having to work for another 5 or 10 years. You know, now don't worry about it because Walmart's always in need of greeters. But is that what you really want to do? So anyway, yeah, I can be a little rough, but you know what? I'd rather you get a little offended here and get your attention to these matters than have you learn the hard way, because that is brutal. It's just brutal, and it's not necessary anymore. It's just not necessary. You get an advisor that tells you not what you want to hear. They're going to tell you how it is. That's what I'd look for. If you're looking for help, talk to 3 or 4, and try to, do the best you can, not based on how big they smile or how warm and fuzzy they make you feel. I would go in for people that are dealing directly with your situation and explain, yes, if you do this, here are the potential outcomes, the good, the bad, and the ugly. Okay? And we're all going to hope for the good, but we're going to plan for the ugly. And I had people accusing me of being really negative because let's imagine like one of the worst case scenarios. So we're going to build a portfolio to withstand that. Okay. And then we're going to hope for the best, plan for the worst, and hope for the best. And when those bests come out and they work, it's awesome. But when some of the worst case scenarios come out and looks like everything's gone down, well, your plan's still in place. Are you down? Probably. Are you down within your risk tolerance? Probably. Hopefully, if you did a good job on that portion. And so you expected it, and it didn't bother you. In fact, every time the market goes down a lot, I will scrounge around and find money to be able to put into stocks. That's just, I'm using funds mostly these days. I have a big stock portfolio, but it's I'm not managing it. I use a market cap weighted approach. It's a model that Fidelity has this platform. It's called FMAX, and I really like it a lot. I can't make a blanket recommendation for everybody. We're not allowed to do that, but it's something that you should probably consider. And you want to see what it looks like, give me a call. Call us in the office. And I'll definitely sit down with you. There's, that initial meeting, there's no charge for that. And we're a fee only. We don't charge commissions. Well, we can get commissions on one insurance product, but that's it. Everything else, most of the assets under management are done on a fee basis. So if you don't want to stay there, you don't have to. There's no sales charge in. There's no penalty for drawing out. We're going to try to do whatever's in your best interest. We'd like to keep you as a client as long as we can until we die. I should say most of you. I have met people that I found we're probably going to work out. We're not going to work out together that well. It's been very few times, but they've been there. And and I'll let you know nicely, if you've got some beliefs that you insist are doable, and that's probably the biggest conflict is when somebody comes in and says, "Look, hey, you can do 15% a year, right? I know you can because that was my friend that referred me over here was up 15% in the last 6 months." Yeah, see, that was called good timing. It was luck. See, but that's not what I would expect on an ongoing basis. And, I don't know. I've been around this industry for so long. I just want you see, if I would agree with that and I could open the account and, yeah, we would make a little bit of money. And then when you found out the next big correction that I was just telling you what you wanted to hear, then you'd be gone and you'd be mad. And actually there's liability there. So Not going to do it. I really appreciate honesty in my own life, and so I try to. That's just the way I'm going to live. I don't want to have to remember everything I ever talked about. First of all, that's very difficult for me to do now anyway. But more importantly, if you're always telling things telling things the way they are, then you don't ever have to try to remember specifically any single conversations because you're having the same conversation. And as it changes, and markets change over time, markets absolutely change. Forecasts change. And I remember when interest rates got down to zero, I'm going, all right, well, probably don't want to be taking out, and it depends on the situation. So you want to take whatever somebody's situation is and customize your recommendations to that person. They're not all the same. Actually, I've never met two that are the same. In fact, I've never met a married couple that had this that were the same. I met a lot of married couples that knew each other and were supportive of each other and listened and were polite and kind to each other. That's awesome. That really works well. And I think it's probably a little more common that one person influences more than the other. And sometimes it's the male, sometimes it's the female. It really depends. So that's the thing I like about this business is that I get to meet a lot of people and have made a lot of friends over the years. I've got about 30 seconds here before they start playing the commercials. So I'll just tell you once again, this is Bill Bullington. I'm here every Saturday morning from 10 to noon now. And you can go to my website, bullingtoncapital.com, if you want to reach out to me. I'll be back after these messages. Well, welcome back. This is Bill Bullington. I'm here every Saturday morning from 10 to noon. If you'd like any information on something that you heard about here or you'd like to call just to set up a meeting, could be on the phone or in person, just go to my website, bullingtoncapital.com. My phone number is there. It's 330-664-0700. And I would be glad to set something up and have a conversation. That's one of the things that I think I've been incredibly blessed by. I've always had a fascination for the stock market. And to be able to make a career out of it has been a huge blessing. I never get bored. I can't say that for a lot of my clients who I know have jobs that are pretty boring. I don't think the boring's not how I would define the doctors or the nurses that I have on board. Their fields are not boring. They're stressful, but they're not boring. I'm not sure I'd want that either. And I take my hats off to those people. Medical industry, holy cow, that's just brutal. So you guys get paid well and you deserve it. Absolutely. But going back, I'm sorry, getting back on track here. The indexing. Like everybody, when you say indexing, they go, "Oh, you mean S&P 500?" No, that is an index, and it's one of the most popular. And a lot of people will use that for comparison. Say, "Well, you can't beat the S&P," and quite frankly, it outperforms a lot of actively managed funds. But a lot of the funds that it's outperforming are not designed to try to beat the S&P 500. Many of them are just trying to put in a decent return while keeping the risk under control, while reducing risk. And is that worth it? Well, if they're successful and that's what you want, yeah, absolutely. So everybody, again, it comes back to everybody is different. One of the reasons I still have a job is because there are almost as many funds as there are stocks to invest in. That's crazy. I never thought I would see that. What does it mean? It means that there's a whole lot of chaos going on out there. And a lot of the movements in financial markets are not because of what's going on at the company. It's because of the current feelings of the investors that move those stocks around. That's what moves the stock in the short run. And the short run, by the way, is anything less than 5 years. And I know that sounds like heresy to people who don't really know a lot about markets. But the short run in stocks is 10 years or less. And if you're able to predict out over a 6 to 9 month time period, well, you got a crystal ball that works. And if you go back and look at that over time, I'm pretty confident that you're going to say, I sure did waste a lot of time trying to do that. And I know that by experience, by the way. Nobody spent more money and studied harder than I did. At some point in time, you begin to realize there's only so much you can know about this. The amount of information or the education is significant. And there are an awful lot of people who are overly confident because those are the ones that like to confront you. And, hey, I'm going to try to stump you. No, you won't stump me. And I will stump you more than likely if that is your opinion. The ones that are really very bright and very well educated, they don't say anything. Why? Because we're speaking the same language now. And there's no conflict. I'm not in competition with you, especially since it's your money that we're talking about. If your money's important to you and you feel like you need to get some help, I understand that completely because it is a lot. It's very complicated. It's you have thousands of options to choose from. Oftentimes, the solutions can be some of the simplest, very simple solutions. I think that's what was it? Occam's razor? Yeah. Simplest solution is often the best. And that quote was done. It was actually a priest that made it popular. Oh, geez, I can't even remember the date. I'll have to go back and look it up, and I'll tell you next week. But I thought it was interesting that somebody wrote it down, and I'm sure that people knew that a long time before. This guy just got credit for it. But simplest solution, that's what I normally look for, is what is the simplest way to get from point A to wherever it is that you want to be. And I think if you take that, it's a lot easier. A lot of people take another path, and that path is to try to study everything and learn everything there is to know about finance to be able to make the very best decision, and they convince themselves that they're doing that, and then they almost never finish the work because it's a lot. And there are those that do. There are tons of them, but that number, they're outweighed. They're the minority. Majority starts working on it and then goes, yeah, I'll put this off for later. I don't know. That Brown game looks awfully good, awfully interesting. Okay, I get it. That's life. It's just life in general. And when you're looking at things that are going on in the economy, every story is new, by the way. Well, this is new. This has never happened before. That's true of every single story. The things that are going on outside the United States right now, things that are going on inside the United States right now. These have all happened a ton of times in history. This is not new. And I remember having a lady, and I know I've probably mentioned this 3 times in the last 3 weeks, but I just laugh about this all the time. When it came in, she was very adamant that war was good for an economy. She was a much older lady, and she had invested during World War II. And she's right. World War II, that actually catapulted us like it or not, out of the Depression. Had to start spending all this money, even though nobody had any money. The government just extended debt. By the way, because the government has the ability to raise taxes to pay off that debt. Now, they have to be very careful with that. But they have that ability that gives it one of the higher credit ratings in the world because that's how our economy runs. That's how a lot of other economies have run that were also successful. So we didn't invent it. We copied it. And we've worked at it really hard. And the United States has been very productive. And now some other countries, China's, if they haven't passed this already, they're catching up. Not sure I would want to live in China. Probably, you look at the YouTube videos, it looks like a lot of it's a really nice place to be. But I don't know, from what I hear about different financial markets, the kinds of things that they're doing. Yeah, I think I like it. I like it here in America with a lot of freedom. Not sure I'd be able to. I'm not sure I'd be allowed to do this type of broadcast in China if I lived there. I have no idea. So I'm not going to take any chances now. But anyway, any events that are coming up that will push the market higher, and there are always events like that. And it's hard to predict exactly which ones. Right now, I mean, there is a boom going on that's not getting much press because of all the other crap that's going on that is getting the press. And this boom is really United States about 3 years ago. And I know I've talked about this multiple times, but it is not over yet. We are just beginning. When we start manufacturing, when we are able to manufacture and take care of a big chunk of the needs for semiconductors in this country, I mean, semiconductors are going into everything. And I mean, everything. I'm amazed when I get in my car and I'm looking at all this stuff and I'm like, it's a computer. It's a computer on wheels. And it's got a bunch of sensors. And it's crazy what'll pop up on my dashboard and has really helped me out a lot. I was like, wow, this is pretty cool. But I would have never dreamed, even 15 years ago that you could do a lot of things that you're doing now. And so life is getting easier. It's improving. Maybe it doesn't improve fast enough for some people. I understand. And I get it. I feel your pain. But and sometimes in some areas it's going too fast. Keeping up is very difficult. I feel that pain too. But that's progress. Once we stop making progress, then we're in trouble. Actually, once we stop making progress, it's because we will have found a viable solution to every problem, and we put the money into solving that problem and got it done. We're not there yet. We have the capability. I am in complete confidence that we have everything that we need right now. We had it for the last, I don't know, it's been decades. We could have solved all the world's problems decades ago. And the problem is, it's one word: politics. Believe it or not, like it or not, they get in the way more often than they have come up with good solutions. Although they do get around to the good solutions at some point in time, because if they didn't, we wouldn't have gotten this far, and we're pretty far. I look around at how I live today versus how I lived when I was a kid. And it is night and day. I mean, that's mind-boggling. We had 3 channels. I think I had a black and white. Well, our family had a big black and white television with no remote control until I was, I think I was in high school. And even then, the TV that we got was not, didn't have any of the features. Well, it had some of the features we have today, but so it's mind-boggling when you look back. And I know Younger generations are like, they roll their eyes and, geez, we have to hear these stories again. But it's fascinating to me, just being an observer. And how does this help you as an investor? Well, if you remember that stuff, if you were to ever go back and look up the stock market indexes going back in 20, 30, 40, whatever, however many years you want to go, look at where they were. Look at where they are now. You really don't want to invest in that? I mean, you all say, yeah, but that's looking, you have the benefit of looking back into history. Well, guess what? One day, people are going to say the same things about today. And the thing about today is, the stocks are not super underpriced. They're not super overpriced. Little on the high side, which is fine. That only means that, you should get strategies that take into account valuations and rank companies based on that in size and speed and profitability. Those are the three most important factors with all the testing I've done over the years. And it makes sense. Those stocks that are going up the fastest, that have the highest profit margins, yeah, maybe they should go up. And what's the right price? I don't think we know. I don't think anybody knows that. They'll go until they don't, which is also why you should have and it's the changing is not as frequent as you think it might be. That's another thing I think is pretty funny. I ran a whole bunch of models to see what the best rebalancing periods would be. That would be when you'd go in and adjust all the stocks that you hold for how much they've moved from the last time. I was shocked that every other year, I mean, think about that. Most people are thinking you need to do that every month. Well, that got blown away. The performance of that got blown away. And I'm not sure if it's just the way things have changed, in other words, whether that's an outlier, if you remember what that means from any statistics classes that you had. I'm not sure if it's an outlier, but it was every other year for some reason. Most people think they should be changing it every day. Well, not most, but a lot of people are like, yeah, no, you will definitely not perform very well. And don't get that confused. A rebalancing period is not the same thing as adjusting the fund for inflows and outflows for that particular day or price movements. Those are different. You can actually reallocate the funds for a bunch of different reasons. Rebalancing is just looking at it and saying, okay, based on this formula that we're using to select stocks, we're going to rerun that, and then we're going to make any changes. If a stock should go from 3% to 4% of the portfolio, we're going to do that. If it should go from 4 to 3, we're going to do that. If the stock should be eliminated and replaced by another stock, we should do that. And there are some certain size, speed, and profitability. After all these years, the funds that focused on that have a tendency to outperform the underlying indexes, which is really difficult to do, and the vast majority of other funds. So if you're out there, if you're a quant, that's somebody who uses math to put models together, size, speed, profitability. I hope that helps you. If you study it long enough, and the only reason that you wouldn't know that is because you're new. As old timers, everybody knows that. It's not really that big of a stretch. That's one of the reasons I really like the innovation that I see. There are some pretty interesting strategies out there that really dig deep. I didn't think they would go that far to see. And one of them is a company that goes in and looks at the actual cash that the company's generating. Incidentally, there's no way, if you're a CPA out there, you know what I'm talking about when cash is whatever that company says it is. Sometimes, they can make a lot of adjustments there. So that's one of the reasons that you want to diversify. And because You can overstate the cash or you can understate it. You can't do it forever. Sooner or later, it's going to come out. And if they've been doing something they shouldn't have been doing, you're going to see a lot of volatility in that stock. Maybe some investigations. But the bottom line is they're not going to do it across all stocks. And the stocks that are included in the indexes, they go through a lot of scrutiny, especially the ones that are listed on like the New York Stock Exchange. They have auditors. They're going out. They're trying to do everything they can within their power to be able to catch the, sometimes they're honest mistakes that people make, but sometimes they're done intentionally. So it's good to know that we have systems like that in place. And I don't hear anybody ever talk about that. They just all assume that everybody's always telling the truth, I think. When you look at some of the talk shows on cable about financial markets, that's where I get that opinion, because I listen to what they're saying. I've only got about 40 seconds before the commercial starts, so I'm going to tell you again, this is Bill Bullington right here on 1420 every Saturday morning, 10 to noon. If you'd like to get in touch with me, go to bullingtoncapital.com. I'll be back right after these commercial messages. Welcome back. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. If you'd like to call into today's show, you can call in at 216-901-0945. We got about another 35 minutes here. Actually, it's probably closer to 25 with the commercials. But I'll try to help you as best I can. And, it's interesting. After all these years, I still don't get bored. That's pretty interesting. I think my career, I guess medical careers would be like that, because you're always finding out new stuff and stuff is always changing. But it's amazing. I thought everybody would know everything by now when I was a young man. That's how optimistic I was. But anyway, there's a really good article. I'd have to recommend this issue of Kiplinger's, and it was the May issue. If you really like investing, and you want to get some pretty good insights into that, I would recommend you run out and get that article for this month. Again, it's Kiplinger's. It's the May edition. In there, and there's an article on what science reveals about hidden emotions that drive financial behavior, and they're giving you some tips on how to handle those. There's the one I like the best, and I've recognized in my lifetime, is a thing called cognitive bias. And that's where you believe something to be true that's not true, actually, and because you're ignoring all the instances where whatever you said was going to work didn't work. I'll just give you a real quick example. Let's say that you noticed that at 3:45 on the third Thursday of each month, the market had a tendency to jump up, fairly significantly, maybe 1 or 2%. And let's say you noticed that, and so you would buy an option, a call option. That's a highly leveraged investment, or you would buy the call on a futures contract, which is super highly leveraged, which means that a little tiny move in the right direction that you catch correctly, you have a chance of making a really pretty good buck on. So what happens is you'll start doing it. And if you're lucky, maybe this trend lasts for, 2 or 3 weeks or longer. But my luck is when I do it, it's going to stop working that day. And this is one of the reasons that I stopped doing those sort of things. And it's funny how people will have these ideas, premonitions even, about what they think should happen, how it should happen, and then it doesn't, and then they get frustrated. And I was like, yeah, that's one of the reasons you want to probably have methods that have worked over time that make sense to you, and that's a big deal. If they make sense to you, and let me give you an example. I have this one model. It's extremely aggressive. Okay, so I'm going to tell you right now, this is aggressive. who should stay away from that? Well, if you can't stand to see the value fluctuate a lot, both directions, incidentally, then you probably shouldn't be doing it. If you think you can, or you just like, I've just got this $50,000 that I would just like to be really aggressive with this because it's not going to affect my lifestyle one way or the other, and I'd just like to make as much money as I can on it for as long as I can. All right, I got one for you. You just take the top 50 stocks out of the one of the indexes, and I'm not allowed to manage. I'm not allowed to give you the name of, unless you can call me. We can set up a phone meeting, and I can give it to you. But anyway, there's it's a growth index, and if you just take the top 40, 50 stocks, it doesn't even matter. You could actually just take the top 20. That's up to you. And you rebalance that thing. What's rebalance? That means you go in. Let's say I decided to go with the top 20. And I'm going to go in every month, once a month, and see which stocks are still in the top 20. Those get to stay. And those that dropped out of that group, they get to leave, and you get to replace them with the new ones. That is an old strategy. In fact, that is 90% of the Janus 20. That's how they were managing that money. Okay? And that's actually where I learned it. Was from a rep there. And it still works today. It works very well. It's just that most of the bigger institutions have billions of dollars, and you can't do that with billions of dollars. You can only do that with relatively small amounts of money. And when I say relatively small, I'm talking about under $1 billion. Like, you could probably get away with it under 150 million if that was the size of your fund. I wouldn't want to try it past that point because your buying and selling would affect the share prices by too much. So anyway, if you're an individual investor and you're out there, that's one of the things that you can do. We actually run a model, and actually, we run a model just like that. But Fidelity's got one too that I use, and I like it better. It's a little smoother. It's actually a lot smoother. So I don't even care if it gets beat. It does well, and I understand the process. They're looking beneath the surface. When you do the S&P 500, okay, that's one figure. It's size. And they're ranking all the stocks by size, and they're just going to take the 500 biggest all the way down to the smallest. That's not 100% of what they do, but those are the stocks that are going to show up in there. And the way that they invest in them is a little complicated. So if you really want to know about it, I definitely can have a conversation with you in person or over the phone. But I don't want to. I'm already boring everybody to death now, so I'll skip that. But it does make a lot of sense, And how does this stuff all come together for your financial plan? Well, when you figure out what kind of risk taker you are really, okay, and it's fairly simple. I know I've talked about this a million times, but when you get that number, let's say, I figure I'm willing to be down 30%. That's what my number is. It's 30%. It's actually closer to 40, but I'm just going to use 30 today because I think that's where my portfolio is at now anyway. But I change it occasionally, not that often, maybe once every other year or so. But I feel like, well, if I'm down 30%, it's not the end of the world. I'm not ready to do anything drastic. I'm not going to sell and go to cash. That's what you want to avoid trying to do. Is trying to time the market, trying to feel like you can time the market. I've had clients who for 20 years didn't, they listened, they said, yeah, okay, I get it. And in the last 5 years, they've made a big mistake. They let too much negative news get to them. They wanted to go to cash, and they went to cash. The market went up, and then they're, oh man, I can't buy now. Well, they kept going up, and then we had to get them back in at a much higher price, and they locked in that loss. And by the way, to get in at the much higher price, that doesn't mean it's not going to go down again. It's hard to, and I get it. These are all emotional decisions, and emotions have no place in investing. Nothing, nada. Big mistake. It's math. It's the numbers. And those are much more reliable than feelings. Math beats feelings most of the time. And what's really dangerous is when you let your feelings take over and you were right. It doesn't mean that your feelings were right. It's just that was coincidence. If you flip a coin enough times, it'll come up heads 5 times in a row. Just keep flipping. Does that mean you have skill? Not really. It just means that you're actually willing to stay there for a very long time. And so you just have, it's all psychological. And I feel bad. I feel like this is kind of really simple stuff for an awful lot of people, but it's still the most important thing. And I remember coming up through, growing up, all the coaches I had, both in real life, because I was always in sales, which is highly competitive. And I don't know that I would have made it in this business had I not been in sports. So I think sports are really important, especially for kids. You're 9, 10, 11 years old, 12 years old. You're going to remember that stuff. I remember it. I mean, actually, some of my better memories are from I was literally a kid. And I remember what some of those old coaches said. You get down, you get knocked down, get up, brush the dirt off, and go right back at it. Don't stop. I think it prepared me for being in this particular field, because you can get the wind knocked out of you all the time in financial markets, and you just have to get used to it. Don't expect to be a boxer and not get punched. I mean, I know most people think, well, that's stupid. Well, it's the same thing in financial markets. Don't expect to be an investor and be right all the time. Don't expect to be right. You don't have to be right more than about a third of the time if you're managing the risk correctly. Let me say that one more time. You don't have to be right more than a third of the time if you manage your risk. And in other words, I'm talking about diversification. And if you look at where the vast majority of returns come from most professionally managed portfolios, it's generally a smaller portion of the money that was invested in certain assets that makes up a large percentage of the gains. It's almost never that, they all went up by 15%. I've never actually seen that happen. Professionally managed portfolios, it's where they all went up by the same percentage. It's never happened, not in my career. So, and if you've got an example of something that's done that, well, send it to me, because I'd love to look at it. I've been doing this for an incredibly long time period. Never seen that. And so, anyway, we got a Kiplinger's magazine. I would recommend this one. It's pretty good. The May edition, and one of the articles in there was 7 secrets to maximize your wealth, and it talked a lot about the financial behavior. There's this guy, Daniel Kahneman. I'm hoping I'm pronouncing that correctly. He's been a long-time writer, was a hedge fund manager, very skilled, and he wrote this book, Thinking Fast and Slow. One of the more important books, I think, in financial management. He was talking about behavioral economics before anybody else was, or at least one of the early ones. And he laid out, the reporter in this article laid out, what he sees happening, how people they're overconfident and how that can hurt you. I've seen that a million times. Gives you a couple of ideas of how you can overcome the overconfidence. And here's the big one. looking beyond the recent past. That's a big one. I can just tell you from experience. What happens is whenever a fund has a really good 12, 18-month run, that's enough to lift your 3, 5, and 10-year averages sometimes by a lot. And I can't tell you how many times I've seen funds who struggled right up until they hit that 3-year run, and it made all the other numbers. I mean, if you, in 3 years, let's say you doubled the money, okay? So that's a little over 20% a year. Over 5 years, it's around 15% a year. You could have been dead flat over the prior 5 years up to that point. And then you finally hit that. So that, again, it's one of the reasons that financial advisors still have a job. I can look at a portfolio and tell you whether or not it got lucky, and hopefully, and that's actually the strategy of a lot of portfolios out there. They invest in stuff, and they're not looking to make money over the next 12, 18, 24 months. They're looking out over the next 5 to 10 years, and those have a tendency to be the best performing, ones that have the longest time horizons. And they'll tell you, and these people are generally very calm. Actually, I always thought about that. If you were ever in big trouble, who would you want to come to your rescue? It's people like that. People that don't get upset a lot. And you can control that, incidentally. Control it by lowering the amount of volatility that you're going to have by getting the right combination of the breakdown between stocks and bonds to begin with. And since I've only got about a minute or so before I have to take a commercial break, I'll when I come back, I'll talk about exactly how you'd know to cut back on the amount of stocks that you have, which is something that nobody wants to do, because generally it's when they're up by a lot that they want to do that, and that's okay. We'll talk about that. We'll talk about a couple other things. Some of the more higher paying fixed income investments right now. I know not a lot of people are really excited about fixed income, but it's actually improving. It's improved quite a bit over 5 years ago. Holy cow. That's mind-boggling. Anyway, this is Bill Bullington. I'm going to take a real quick commercial break right here on 1420 WHK. Don't go away, because I'll be right back. All right. Hey, this is Bill Bullington. I'm here every Saturday morning from 10 to noon. You can go to my website, bullingtoncapital.com, if you want to contact us or you'd like to talk about your situation. By the way, I don't have a favorite portfolio. I have some that I know I like better than others, but more often than not, it's just stuff that is not really generally available to the public, because it was they just don't make them available to the public that often. There are similarities. There are instruments out there that you can do a lot of research on, what you should be doing, hopefully. And there's some really good stuff. And you don't actually have to have an advisor, but if you are unsure, if you're getting close to retirement and understand that you can't afford mistakes, or just want to get a second opinion, feel free to go to my website and give us a call, or fill out the form and send it through email. And the email address, if you don't want to go to my website, which I can understand, is just bill@bullingtoncapital.com. And you can just email me there, and I'll try to call you back. Anyway. So I'm reading Kiplinger's. I read a lot of stuff. I have a Bloomberg terminal, by the way, which is pretty expensive. It's actually very expensive. Who am I kidding? And I used it when I was younger to really, it was a great learning experience. And now I don't really, I go back and I just kind of verify the research that things haven't changed a whole lot from what they have been in the past. And there are some subtle changes that have occurred over the years, but they're very minor. And one thing that hasn't really changed is investor behavior. Unless you spend a lot of time working on this, and it depends on your personality, that has a lot to do with it. But it's a lot of work. I mean, it's a tremendous amount of work. And this month's magazine called Kiplinger's, a lot of you probably heard that. One of the articles in there was 7 Secrets to Maximize Your Wealth, and it actually has more to do with psychology than telling you which stocks to buy. And I really like that. This guy, Dan Kahneman, he was the pioneer of behavioral economics. And again, he wrote the book Thinking Fast and Slow. That book has been out for a long time. It's more than 20 years. It's still worthwhile. I still have a copy of it, by the way. And one of the things that he said was our brains are wired in ways sometimes to cause us to take actions that aren't good for our financial health. And wow, yeah, I can tell you. And most of the time, you don't even realize that you're doing it. That's why when people said, "Well, yeah, you don't, financial advisors are going to be out of business," really, because we're not really. It's not that we know more about a lot of financial topics, which more than likely we probably do in most cases, but we also have been trained for a long time on the psychological responses and how to evaluate, how to bring the information. If somebody needs to make, if you need to average above 7% a year, that's going to be tough. It's going to be tough. And I know a lot of people say 7%. Well, this mutual fund did. Yeah. Well, it was over a specific time period that you're looking at that performance, and you didn't see the volatility of that fund either. I promise you. Any fund that's got a better than 7% average annual return that's been around for at least 5 years has had some big ups and downs. You know how I know that? Because they all do. Not a little bit. And there are some ways, and there are some investment managers who have the guts. That's the one thing that everybody's got to come up with. I mean, S&P 500 is in the top 10% for a reason. Because the vast majority of people break down, and most don't even have time. I don't know. If I didn't do this for a living, I worked in some of the fields that some of my clients work in, I wouldn't have time for this. I wouldn't have time to do a good job and ever feel completely comfortable about it. And it's really funny. I have some clients who have been very successful, that don't really have a lot of knowledge and don't spend a lot of time, looking at their investments. It is a riot. They just threw the money in there and let it rip. That's mind-boggling, and everybody. I just am not that lucky. That's just not me. I feel like I had to know what I was doing, or I had to have a feeling of an understanding of what's happening, and when my clients call who are in that shape, and I talk with them all the time, and it's like they call. We send out emails all the time. But and all the emails are like, "Hey, give me a call if you need to talk about something specific, or if you just want to hear my voice because markets have been very rough lately, and you want to have some conversations that are not negative, because there are always positives." And like I was talking about earlier on today's show, I was laughing when this older lady. She was in her late 70s when she was telling me this. I mean, she leaned over like she was going to tell me a big secret. And she said, "Wars are good for an economy." And I was like, yeah, I can't get away with saying that. But so I'm glad it was somebody out there. And what happened, and I don't even know, I'm sure she had a fundamental understanding, when you're producing a whole lot of uniforms, ships, Jeeps, you got ammunition. Those are big expenditures. Those things are all purchased here. Wouldn't it be crazy if the Army was buying uniforms from China? I wouldn't put it past it. But, or at least from some of the importers that are importing from China. That is so funny. Well, maybe not to you, but I just think it's very ironic. And we are so... That's why, personally, I think it's unlikely that we have World War III, because economically we are we're so dependent on countries all around the world. It is a worldwide economy now, and you should see how many foreign countries would rather take the dollar rather than their own currency. That's pretty wild. And take the Chinese yuan down, and that's always going to be. Everything's always changing. That's the one thing. When I was a kid in this industry, I was looking at this, and I had been studying this forever, and I came up with this conclusion that the only thing that was constant was change. That was it. And it's one of the reasons that you can't just set stuff and forget it. Now, there was a time period, and I saw people that made an unbelievable amount of money because they had purchased stocks 30, 40 years ago. They never even looked at it again. Those were actually the most successful investors. I had one gentleman, he had more stocks than most mutual funds do. It's like 500 stocks in his portfolio. He never sold anything. And he just loved stocks. He would hear a story, he would buy the stock, put it away, and never look at it again. And it was mind-boggling. It took me, a couple of months. And so this is when I was young, had a ton of energy. It took me a couple of months just to help him sort through all those stock certificates that he held. And we had to take an inventory. And then he finally, he just deposited them in an account. And we were able to help him a lot. He had continued buying stocks all the way up until he called me. So stocks that they had lost money on, we would take those and slowly we were moving the money into taking gains on stocks that would be offset by losses. That took 6 months working, because that's how many stocks that dude had. It was like most mutual funds didn't even have anywhere near that many. Anyway, so what was really wild about this is the guy lived off of close to Clark and 25th, the corner there. He didn't live that far from there. This guy's got all this money, and he's a multimillionaire long before that was a popular thing. And he was a tailor. The guy was a tailor. And the reason he got interested in stocks was that he was evidently a good tailor, because he had a lot of clients who were in the investment world and the business. And they told him, hey, you should invest in stocks. And so he started doing it. And he did it from like the early 1940s. And when I met him, it was in the early 2000s. And as a long time too. That's a big advantage. And the fact that nobody wanted to, when he was buying stocks, nobody wanted to buy stocks. They were all deathly afraid that they were going to go out of business. And his philosophy was, look at the sales, look at the profits, look at the dividend yield. And that's how he made his decisions. And boy, talk about right strategy for the right time. That would have worked wonderfully for about 30 freaking years. And then you get up into the mid 80s when valuations started getting a lot more elevated. And that's where they're right now. The elevation of the stock market, it's pretty high. The earnings yield, I forgot what it is. It's not super high though. If I'm looking at if I have more than 10 years to invest. If I have a life expectancy of more than 10 years, then stocks are still okay. Now watch them all crash because of that, because I just said that. Anyway, I hear the phone ringing, but I'm going to have to actually check out here in just a couple minutes. But if you want to call me in the office, go to my website. It's bullingtoncapital.com. And all my contact information is there. You can reach us by phone, or you can just send me an email. Be glad to respond to you. I always talk about a lot of different topics. In fact, if you're listening out there and there are some topics that you'd like me to research and include on my radio program, go ahead and send me an email. It's bill@bullingtoncapital.com. I'd be glad to look it up for you. There are so many facets to this. That's the thing that's always been around. That has not changed. It's easier to look stuff up, because you can Google just about anything, but a lot of this stuff is pretty complicated and needs to be looked at from more than one angle. Sometimes that's difficult to do if you're doing it yourself, but I understand, and I'll try to help you any way I can. And I've got about 30 seconds here before they kick me off. So I'll tell you one more time. This is Bill Bullington. I'm the owner of Bullington Capital Management. Go to my website, bullingtoncapital.com, if you'd like to reach me. And have a good week, everybody, and good investing and good luck.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.